All right. Well, good afternoon, everyone, and welcome to our 2023 third quarter market update and outlook webinar. My name is Dana Vosberg. I'm the Managing Director of Advisory Services here at Manning & Napier. I'm happy to be joined by Kelly Coveley and Ethan McKinney today. Kelly is an analyst in the Quantitative Strategies Group at Manning & Napier. She's a member of the management team responsible for portfolios developed by the Quantitative Strategies Group. As such, she supports Manning & Napier's disciplined value and ETF-based products. Kelly also contributes to the development of market and economic overviews for the firm. This includes constructing indicators to assess risks and opportunities in various asset classes, as well as providing statistical analysis to support the investment research efforts of the firm. Kelly has been with Manning & Napier since 2015 and is a chartered financial analyst. And then Ethan McKinney is a senior financial consultant at Manning & Napier and certified financial planner professional. In this role, he's responsible for coordinating all aspects of client relationships within Manning & Napier, both individuals and institutions, and covering a full range of investment-specific discussions and comprehensive financial planning topics. Ethan has been with Manning & Napier since 2005. Thanks, Kelly and Ethan, for taking part in the webinar today.
Thank you.
Yeah. Well, as we get started, we just want to know where everyone is joining from today. So please feel free to type in your location in the chat section. It's always interesting to know where people may be tuning in from and who we're reaching with these webinars. And we also encourage you to ask questions. So if you have questions at any time, please submit them using the Q&A function located at the bottom of the screen, and we'll spend remaining time at the end of the webinar answering as many questions as possible. So it's great to see people chatting in their locations. We got coming in from all over the place. So thanks very much. It's nice to see that. All right. Well, we have a lot of really good information to cover today. In many ways, we're continuing the conversation from the second quarter market update and outlook. We'll revisit, where things stand in our view for the U.S. economy and what we're seeing in equity and fixed income markets, and also cover important planning considerations as we move into the fourth quarter here. So, but if we really want to boil the overall theme of what we'll be discussing down to kind of two main takeaways. One is that the economy continues to gradually track along, as you might expect during a late cycle period. Despite, I think, some of you saw it, this morning's GDP report showing strong consumer numbers. And we're seeing growing signs that more challenges are on the horizon. And Kelly will go into detail on what we're seeing and our thinking when it comes to navigating this period as we look ahead. And then the other takeaway is, I think, related to how you can gain confidence in your own personal financial situation, despite the uncertainties and challenges we're seeing. So taking time to review your personal plan and stress test scenarios can provide very helpful context, as well as make it easier to identify action items and next steps. So there are certain things you can't control, obviously with the market and other areas, but regularly reviewing your plan, understanding the controllable aspects that help to keep you on track for achieving your long-term success and your own personal goals can provide a great deal of comfort. So that's another important takeaway. So with that in mind, we'll launch our first poll that we have. We have a couple of polls today that we'll be going over. You should see that popping up here. So really, the question is, when it comes to investments and planning for the future, what is the most top of mind for you? Recession, inflation, taxes, political environment, or all of the above? So we'll let people submit their answers there. And, there's a number of things, obviously, that can change, I think, depending on the day or the week. That some people may suddenly be more concerned with one over the other. So that I'm sure it can fluctuate depending on kind of where your mind is. But so we'll see the results here in a second. There you go. Yeah. So interesting. Yeah. All of the above. A lot of people are coming out as the winner, over 50%. So that's something that I think people have a lot of things on their mind right now. So we hit a number of issues that I think people are concerned about. So Ethan, let's kick it off by covering some of the important planning considerations. The fourth quarter tends to be a time when we see a lot of activity to really address things before year end, or people may have, not tackled them earlier in the year. So it's kind of a time to catch up. What are some things you're thinking about right now, and what are you covering with your clients?
Thanks, Dan. And I want to first talk to that poll again really quickly. I'm not surprised to see all of the above as the top response there. On a regular basis, anytime I sit down with clients and just ask what's on their mind, it's the list is growing. It's not as simple, I just want to make sure I'm okay financially. It's all the different data points that they're hearing out there and trying to comprehend and understand how it's impacting them. And so what, again, Dana, you had mentioned, our goal is to highlight specifically what can you control and what can you not control. And a number of those items in that poll, recession, inflation, and so on, are items that you need to plan around, but yourself cannot specifically control. When it comes to planning and thinking about the future, it's important to start by saying, okay, what can I control? What can I do today to make sure that I'm in the best financial spot, not just for the next 6 months, but the next decade and more. And a lot of that's based on utilizing different planning tools that exist that can help make sure that your money is set up and structured in a way that again minimizes taxes and is set for the future. And so a lot of those things, as you said, Dana, are annual type items, whether it's adding money to certain accounts or having to take money out of accounts, that typically has to be done on a calendar year basis. And so it's always good this time of year to take a step back and say, have I maxed out what I've put in my 401k? If you're working, if you have kids or grandkids that you're saving for college for, have I completed those gifts to those accounts on their behalf? Have I given a charity to the level I want to, knowing that all of those items will impact your taxes for the 2023 year? Have I put money into an IRA or a Roth IRA? That is the one item that you actually can delay and not contribute till April of next year. The other ones all have to be done by the end of this year. And so it's important as you kind of think about, the next 8 or 9 weeks, what you need to do. There are typically a number of items you can do that your advisor at Manning & Napier can help guide you through. So that's kind of additions to things, or kind of giving money away. When it comes to, accounts and what has to come out, the rules about required minimum distributions have changed a bit over the last few years. And so kind of keeping some of those changes in mind is important, because any money that you take out of an IRA is taxable income to you. So again, how do you manage that total tax and income picture? The law used to say for a very long time that you had to start taking money out of retirement plans starting at age 70 and a half. Over the last few years, that has evolved. And today, the deadline, or the age that required minimum distributions begin, is age 73. So that's pushed out. So understand, if you're now at that age, you have to take out a set percentage a year. We always make sure our clients do that, because the penalty for not doing so is 25% of the withdrawal amount, which is a pretty substantial, it's one of the most substantial IRS penalties that exist. So you want to avoid that. And when it comes to withdrawals out of inherited IRAs, those rules have changed too in the last few years. If you had inherited an IRA before 2020, you had an annual, and you still have an annual required distribution that has to come out each year. If you inherited it since then, you do not have to take money out of that inherited IRA in 2023. You might have to in 2024, and you will have to within 10 years of inheriting the whole account. But so how do you, again, plan around those distributions, knowing that it is taxable income to you? And that, again, is something that your financial advisor at Manning & Napier can help with. So again, a lot of that is kind of focusing on controlling what you can control, and letting us manage the risks in the economy around that, which kind of gets over to Kelly. Kelly is going to get into our economic outlook now. There are a lot of risks out there today. As we look at the data, there's further indication in our mind that a recession is forthcoming. Now, that does not mean that the world's ending and the stock market is going to have a 2008 type crash, but it does mean that the conditions have steadily deteriorated in the economy, and Kelly's going to touch on that. But also, obviously, if we enter that environment, or even if we just enter more volatile times, you really do need to be much more selective with the types of investments that you're investing in. And of course, that's one of Manning & Napier's areas of expertise, is finding those suitable investments in different and more challenging market environments. So Kelly, I know you want to start with an example based on some sentiment data. As you look at the news, there's different, some days it feels like we're entering a recession, other days it doesn't. I think there's a stat you want to share with everybody.
Yeah, so 2023 has been a very interesting year. You entered the year, and there was already a lot of talk of recession on the horizon. Now, as you moved your way through the first three or so quarters of 2023, really big signs of that recession hadn't yet occurred. And the longer that got pushed back, the more people started wondering about the possibility for this soft landing scenario. And a soft landing is when the Fed hikes rates to bring down inflation. Inflation does come down to where the Fed wants it to be, and you don't have any substantial economic pain. Unfortunately, history suggests that soft landings are very difficult to achieve. And that's because rate hikes are by design intended to slow the economy. That's how they bring inflation down. And they do usually act with a pretty long lag. It takes time for the impact of any given rate hike to sort of really be felt throughout the economy. And that's why a lot of the time you actually have a spike in discussions on soft landings before a recession begins. Since rate hikes take a long time to play out through the economy, you kind of start to see the impacts of them in just pockets of the economy at first. And that's what we're starting to see already. We'll start with the labor market. Unemployment still remains fairly low. Job growth is okay. And that's because companies really don't want to lay people off. They're going to wait until they're really, really feeling the pinch on the economic side before they actually lay off their existing workers. But there are steps they can take before they lay off existing workers. And we're starting to see some of this start to play out. So the first chart here is temporary payrolls. We've seen this decelerate a bit. And you can envision a company saying, growth hasn't been too good. I definitely don't want to lay anybody off, but I'm just going to not hire those temporary workers I had been hiring. We also see this coming through in seasonal hiring. We have the holiday season coming up. This is usually a time when companies hire extra workers to deal with that extra demand. And what we've seen so far is that intentions for seasonal hiring are the lowest they've been since 2008. So another way that kind of weakness is starting to show up here and there. And we've also seen job cut announcements come up. So this is when you see in the newspaper, the manufacturing plant announced that they'll be laying off 10% of their workforce. We don't actually know exactly when those workforce reductions are going to occur or how exactly they're going to be implemented. But companies really don't want to make those announcements unless they intend to follow through with them. So that provides us with some really good forward-looking data on the labor market. Now, on the consumer side, savings have been drawn down slowly but surely since the pandemic stimulus that put a lot of money directly in consumers' pockets. They built up sort of a war chest of savings. And since then, what we've seen is they've been spending those savings. And while those savings are being spent, it does boost economic growth. Unfortunately, there comes a point when those savings are depleted and you're going to lose that boost to spending that savings had been providing. And then finally, on the wage growth side, we've seen wage growth come down a bit as we've seen those cracks in the labor market start to come through, but it's still running above the level where the Fed kind of wants to see it. Wage growth is good for workers, but it can feed into inflation. And inflation, like wage growth, has come down a bit, but again, is trending above the levels where the Fed wants it to be. So they're going to kind of keep their foot on the brake until they see those trending more solidly towards where they need it to be.
Great. And Kelly, we've talked a lot about indicators in recent webinars, and when you were talking about, sort of Google searches, I'm sure economic indicators is a very common search for people, and they're kind of trying to get a sense of where things might be going. And it's a word and that we see a lot in headlines, and sometimes it can maybe take on a bit of a generic sort of quality to it. But when you're doing your work and you're thinking about these things and looking ahead, what is a leading indicator? Just maybe define that or talk through that a bit.
Yeah, sure. A leading indicator is something that tells us about what might happen in the future. A lot of what you see in the newspaper are the big, really, really important numbers for the broad economy. This is things like GDP growth and unemployment. And since these make up such large portions of the economy, they tend to move in tandem with broader economic growth. Since the market is forward looking, most of the time the market's going to move ahead of the broader economy. So by the time GDP growth declines, the market will have already gone down. And this is why we focus so strongly on leading indicators. This is things like initial jobless claims or consumer expectations that tell us something about what might happen down the line. And I mentioned GDP growth as a coincident indicator. We had a GDP release just this morning, and it was quite strong. It was, well above 4%. And to be in a recession, you need negative GDP growth for a couple quarters. So we got that kind of apparently good number. And today the market is down, which feels a little counterintuitive. But that's because the market is so focused on always sniffing out what's going to come next. And there were some numbers, even within that same GDP report, that suggested that the GDP growth number we saw was potentially unsustainable. So you had real disposable income fall and the savings rate decline. So that kind of points to a fragile consumer that might not be able to keep up that level of spending that we had in the previous quarter.
Yeah, and something else that I think has been in the news and people may have seen quite a bit lately is just the college loans and repayment of college loans that is actually starting back up again when there was kind of a hiatus for a while of coming out of the pandemic and some of the challenges there that people were facing from a cash flow standpoint. Now those in October are required to be paid again. So Kelly, can you talk a little bit about maybe the impact there? That's another hurdle potentially, or another, I guess, headwind, I should say, that is facing the consumer.
Yeah, definitely. So this chart here, the light green line shows us delinquencies on student loans. So who's at least 30 days late on paying the payment they're supposed to have paid. And we can see for student loans so far throughout this cycle, it's remained very, very low. And that's because most of those loans did not need to be paid. But when we look at delinquency rates for credit cards and auto loans, that has started to tick up, even as the consumer had all those excess savings and didn't need to repay their student loans. And what's particularly concerning about this is if you look under the hood of this data, you can see that a lot of the increase that we've seen has come from people ages 18 to 39. And those are also the people who have the disproportionate share of student loans that now need to be repaid. So we view that as putting some stress on an already fragile area of the consumer.
Yeah, Kelly, I always make sure I point to this slide, when I'm talking to clients, and then a lot of them say, why would I care? I don't have credit card debt, student loans or auto loans. The reality is it's going to be additional stresses on the broad consumer. You shared earlier, savings amounts had fallen from 6 trillion down to 800 billion. That's an 85% decline in savings. So you combine higher cost of goods, less money to pay for them. Consumers are getting stretched thinner and thinner, and now you're going to add student loan payments back into the equation. It's going to cause a ripple effect in terms of how that's going to impact the health of the economy and the ability for consumers to buy goods at companies. And so there will be in our mind a a detrimental impact to the economy and the markets. And that's why, again, even if a client on this call says that this is not a concern of mine, it becomes a broader concern when you put all the pieces together.
Right. Well, switching gears a bit, 2022 was a historically bad year for bonds as the Fed aggressively increased the Fed funds rate, and investors were faced with something that most haven't experienced, maybe ever, and it personally, and then most investors in a couple of decades. That's basically a rising rate environment, and one that was extremely sharp too. So, Kelly, can you give us an overview then of the fixed income currently and just that area of the market and thoughts as we look ahead?
Yeah, sure. The really sharp move up in interest rates was quite painful for bond prices. And that's because the price of a bond always moves inversely from its yield. And this makes sense if you think about starting out with a bond someone issued paying a 4% coupon. You hold that 4% yielding bond, and all of a sudden rates go up to say 8%. So now companies are issuing bonds with 8%, and nobody wants to buy that bond yielding only 4%. So the price of that bond has to fall until its yield matches what's out there on the broader market. And this is a very painful process, particularly when you're starting from such low starting yields. But that painful process got us into a much more favorable setup. Now bonds are giving a much more attractive yield than they were when rates were close to zero. And the next slide puts that in a little bit of a broader context. This chart plots out the yield on a few different types of bonds and the earnings yield on the S&P 500. Now, as you move from the left to the right on this chart, you get increasingly risky areas of the market. And the normal pattern for as you take on more risk is you take on more return to compensate you for that risk. And those gray bars are the sort of normal increase in yield as you get riskier securities that we've seen over the past 5 years. The blue dots are the yields we're seeing today. And you can see that you're not getting particularly favorable additional yields as you move to riskier securities.
Exactly. And so it kind of begs the question of, how should you be an allocator invested today? And for our clients who have exposure to stocks and bonds, where we're adjusting the asset allocation for them, over the last few years, we have steadily increased exposure to safer investments, whether that's shorter term treasuries or higher quality bonds, or quite frankly, stocks that are in less risky industries or less volatile industries. It's kind of reducing risk, not necessarily taking all risk off the table, but it's kind of adjusting based on the environment that we're in today. And when it comes to possibly what you could see hypothetically in people's mind is the least risky place to be, that would be a CD at the bank. Many times, when you walk into a bank today, and you look on the wall, you see you can buy a 5% or maybe even slightly higher guaranteed CD from the bank. And it's a question I've gotten frequently in the last couple of months. I understand you have a cautious view on the markets. Why don't I get out today, buy a CD, and get back in when it makes sense? And so there's a few issues there that I want to go through. The first is kind of how CDs work in general, and then the second is the idea of trying to time the markets. But when it comes to investing in CDs, one aspect that many investors are not fully aware of is that income earned, or that expected yield, is a taxable income item on the federal and state level to the investors. So you might earn 5%, but after taxes are paid on that interest, you end up having a after-tax yield that's hypothetically less than the current rate of inflation today. So that's one risk there. The other is an investment in a CD at the bank is less investing and is more purchasing a contract through a third party. If you think about what you're doing when you buy a CD at a bank, you're saying, please hold my money for a set period of time, and in the future, you'll give me back X% more. That's very different, obviously, than other types of investment options that are out there. And with that contract are a few cons. One is that money is tied up. So if you want the money out before the end of the term of that CD, you typically have to pay interest penalty of several months to access your funds. And so if it's tied up that long, A, that's both a liquidity risk to you, and B, when that CD matures, the question is, what do you do then? Are you going to purchase another CD at the prevailing rates, which might be a lot lower and you have less options on the table? Or are you going to then say, well, I guess I'll just get back into the market? It might feel safer now. And you're in essence saying, no matter what happened in the prior 18 months, I guess now is when I'll re-enter where I should have been the whole time. And we always say, think about what your actual needs are for your assets. And many times, having some money invested conservatively in a cash-like investment absolutely makes sense. But if it's not consistent with your objectives and you're just unhappy with market results the last few years, it typically is not a great place to go. Now, for an investor who is looking for a shorter term, safer strategy like a CD, we often instead recommend investing in shorter term treasury bills. And the reason we do so is some of the risks I outlined with CDs dissipate when you invest in a treasury. One being, yes, a treasury is taxable on the federal level, but is not taxable. The income is not taxable on the state level. The yields on treasuries tend to be a bit higher than what you earn on a equivalent CD at the bank. And third, there's not the liquidity risk that exists with the CD, where if you want to get out, in a less time than a set maturity date, you can freely trade those bonds on the open market. So again, that you'd want to invest in either of those types of investments if it makes sense within your plan, but it should be looked at along those lines.
And the question came in relevant to this, just maybe tackle it right now, is somebody just asked, kind of our thoughts on how high treasury rates may go, maybe in shorter term rates in the next year or so. Is there a thought process there that we can share on sort of those expectations?
Yeah, I think typically rather than making point forecasts for a given interest rate, we really tend to focus on how attractive is any given investment relative to what else is in our opportunity set. So right now, treasuries are pretty attractive. I talked a bit about treasuries relative to equities, bonds finally paying a decent yield. And then within the bond market, we also think treasuries are pretty attractive relative to the riskier areas of the bond market. So investment grade corporates and high yield, because right now those riskier areas of the bond market are not giving you that much more yield than you have on the safer treasury investments. And in terms of what treasury maturities we're most interested in, right now the yield curve is pretty flat. So you don't take on, you're not getting that much more yield for the longer dated securities, but we do think it's worth kind of broadening out your exposure a bit, just because at some point we do expect economic pain. At that point, the Fed will likely cut rates and short rates will go down, and sort of locking in the attractive yields we're seeing today at the kind of middle of the curve is an attractive strategy in our view.
Good, thanks, Kelly, for answering that. We have another poll that we're going to launch here. You'll be seeing in a second. That's talking about risk, or asking about risk, I should say. So on a scale of 1 to 5, how risky of an investor do you consider yourself? 1 being very risk averse and 5 being very comfortable with risk and some, what the equity markets may do. So if you could please take a second to add what you answer what you feel is maybe where your mind is with risk right now, and we'll move on from there. But this is another area that is probably can fluctuate for people depending on what they're experiencing and the news of the day. So all right, and then so it looks like with about a third kind of middle of the road rating a 3, and then another third about 4. So seems like, in general, a little bit skewed maybe to being comfortable with a bit more risk. So Ethan, and I guess I think you were going to talk a little bit more about that and expand on kind of how to think about risk maybe.
Yeah, and those results with a lot kind of centered around the middle to slightly above risk it makes sense to me. If you think about it, in the last 2 years, the safe investment of a bond has performed worse than the risky investment in a stock, or at least has not provided the protection it historically had. And so there's some fear, obviously, that that would continue. But as we've discussed, as Kelly discussed earlier, with higher yields on the fixed income side, that does provide a lot less risk of continued pain on the bond market. But the question comes up a lot of the time, and I mentioned this earlier. Do I continue to stay the course right now, knowing that it's been a challenging few years, and your outlook is less pessimistic, or is more pessimistic than it is necessarily optimistic today? And the risk there is, of course, if you get out at any point from your long-term strategy, when do you get back in? And if you get out, you may very well, even if it is a more volatile time, miss out on some of the best days in the market. So this stat here shows, had you invested in the S&P for the last 30 years, you would have earned 7.7%. If you had missed just the 10 best days out of, I think that's 7,000 days in the last 30 years, you would have 6.6%. So just missing a very small amount of time is a big risk. And obviously you miss the 20 best days, that's an issue as well. And so, our priority as financial advisors is to help set objectives, help determine what type of strategy is most suitable for you. And that may be having a few different pools of money invested in different ways, some more conservatively where you have near-term cash needs, and some more aggressively. And the key is just sticking to those strategies and ensuring that you're positioned for the future. And so up to this point, we've talked a lot about asset allocation. I do know we want to talk specifically about the stock market itself. Kelly, do you want to talk about what has pushed the market recently?
Yeah, so through the first 3 quarters of the year, market returns were quite strong, but a lot of those returns came from just a handful of large stocks. This group has been dubbed the Magnificent Seven. We have them listed here, and they started out as a pretty big part of the market and had really strong returns, which really juiced the broad market returns. But in that same time frame, half of the stocks in the S&P 500 actually had negative returns. And that puts us in a situation now where a very small number of stocks make up a very large portion of the index. And this chart here shows us the weight of the top 10 stocks in the S&P 500 over time. And we can see we're now very concentrated relative to what we've had historically. Some of the positions in the index for these individual companies are large, really, for any portfolio, let alone for an index. And that introduces a pretty large amount of stock-specific risk. Now, we do own some of these names. We own 4 out of the 7, but not having the kind of full market exposure has been a drag on portfolio performance. And that is definitely painful, but we think it's really, really important to keep our focus on selectivity and paying the right price for any investment we make. There's a good saying out there that the market is there to serve you, not to instruct you. So I will say, I think most of these are good businesses, but that doesn't necessarily mean that the price people paying today for them is a fair price. And it also doesn't mean that the weight in the index, the big weight in the index to some of these names, is the weight you want to hold in your portfolio.
Thanks. This is actually a good segue to another poll question that's going to pop on the screen now, which says, which of the top 10 stocks were also in the top 10 20 years ago? And when we say top 10, we mean in terms of size of market weight. And the answer may surprise you as you look at these choices that only, well, I'm not going to spoil the end, but only one of those 4 was a top 10 largest company 20 years ago. Give you another moment to take your best guess.
pretty much are in everybody's life, every single day. That's who those companies are right now.
Okay, and I'm proud to say that our client base is pretty smart. The correct answer is Microsoft. And not surprised to see Apple is the second highest guess there. But the point that I want to make here is the companies that are the strongest today, strongest meaning the biggest and have provided great returns the prior 5 or 10 years, does not necessarily mean that they're going to be the best companies to invest in the next 5 or 10 years. And although you could look at these lists and say Apple will be the biggest company in this country forever, that may or may not be the case. If you want to actually look back at what those top 10 companies were in the market 20 years ago, they were General Electric, you may have been able to guess that, Microsoft, ExxonMobil, Pfizer, Citigroup, Walmart, AIG, Intel, Johnson & Johnson, and IBM. And again, those are still great companies as a whole. But if you had invested in those 10 names 20 years ago, you would have thought you couldn't fail. And obviously some of those names have fallen back and there's been new winners. And our goal, our job as an investment manager is to find not what's done well recently, but to find a good company that's selling at the right price to invest in for our clients on a go-forward basis.
Great. And as I mentioned at the beginning of our comments today, in many ways we're kind of continuing a story. So in the last Outlook webinar, we talked about keeping a perspective on long-term and on the longer-term trends, and we highlighted the age-old challenge, I guess you'd say, of how short-term periods can have a way of overshadowing longer-term results or trends. So if you remember, so just think 5 years ago, the market was humming along before COVID. We had a perspective at the time that the market was actually overheated. Then everything did eventually, in 2020, turned upside down with the pandemic. Markets came charging back historically fast through the second half of 2020 and then 2021, and then all areas of the market struggled in 2022. This year has been a bit more of a mixed bag, with kind of a stronger start to the year in many ways, and then the last quarter was a challenge. But this updated chart here shows the cumulative returns over that 5-year time period and that I just mentioned, and sort of looking at a range of multiple asset class strategies, and the dark blue bars represent Napier's multiple asset class strategies versus comparable benchmarks. So there's just a couple of takeaways, I think, as we look at this again this quarter. For one, they're continue to be meaningfully positive, right? A lot has happened over the 5-year period. And you can see that, especially for allocations with higher equity exposure, the portfolios have been able to generate strong returns and also relative to benchmarks, but just strong positive returns over a 5-year period that felt very volatile at times. And our responsibility to our clients is to manage through risk and remain flexible through those significant ups and downs. The other takeaway is that we touched on earlier a bit is strategies with higher levels of fixed income. Maybe they haven't generated as much cumulative return over the last 5 years as you might want or expect, because rates have been so low for a period of time. But going forward, fixed income, really should have a bit of a tailwind now with the rates being higher, as we talked about, and having a situation where there's a little bit more selectivity when you look at both your options with fixed income and then in growth perspective with equities. So, not necessarily relying on stocks to be the only portion of the portfolio generating growth. And then the next slide is just a view of similar information over different time periods, but same portfolios and how they've performed versus some comparable benchmarks. So, shifting focus a little bit, I guess, we want to take a look at opportunities now after we're just talking about what we've seen and some of the things we've experienced. But Kelly, talk about maybe the opportunities we're seeing as we look ahead, and we want to make sure that we're positioning portfolios under the current environment and some of the challenges that we might be facing.
Yeah, sure. We're seeing plenty of opportunities. We are excited about. I'm going to start out and answer a couple questions I've seen come
Okay.
in on sort of the AI space and the lack of exposure to NVIDIA. I know this year there's been a lot of talk of AI. It really is the large language models. I think are pretty cool. I've used them a bit myself. And going into the year, we did have exposure to some semiconductor companies, and this was for a few reasons. The semiconductor space had a lot of demand during COVID, and then as we returned to normalcy, things fell off of those high levels. And a theme I'm going to talk about a few more times on this slide is that a lot of times your best opportunities are in industries that are experiencing pain. And that's actually what we saw in the beginning of 2023 in certain areas of the semiconductor space. Now, we took on exposure to these partially for seeing the secular themes that are good for semiconductors, not just AI, but also cloud computing. But there was sort of this added boost of a favorable setup on the cyclical side. NVIDIA, unfortunately, was kind of expensive going into the year. And since then, it's really been priced for perfection. And so far, the company actually has delivered perfection, which is really rare. And we've focused instead on companies where there are just more ways to win, a favorable setup both on the cyclical side and the secular side and the valuation side. And we maintain exposure to those companies today. And then moving on to railroads and housing, these are both industries that already have experienced almost recessionary conditions on the fundamental side. And usually those conditions give you the best opportunities to buy really good companies at compelling prices. Investors get a bit overly fearful, and the price of stocks in those industries decline kind of regardless of how good the company is. So we have taken on some exposure there. And given our broad economic outlook of some further softening on the horizon, we have remained focused on companies with really strong balance sheets and also strong business models. So we have favored companies with really strong brands or large existing networks that would be really difficult for a competitor to replicate. And so we've been able to take on exposure to these companies at favorable prices. And we expect that they're strong enough that they can weather that kind of economic storm we see as likely.
Great. So as a way to conclude, some of the prepared comments then before Q&A, can you, both of you, can you touch on a few key points that you think are really worth reinforcing just based on all the material we covered? And Kelly, we can start with you then on that.
Yeah, my important points are that inflation is not yet where the Fed wants it to be. They're going to be keeping their foot on the brakes of the economy, whether that's through additional rate hikes or even just keeping rates at the current high level they're at today. That will continue to be a drag on economic growth. Because of that, we expect the cracks we've started to see in the economy to continue to spread into broader economic weakness.
Yeah, and when it comes to how to invest in light of that outlook, it's really about being nimble, cautious, and it's not avoiding risk. It's just managing risk and finding the right places to be. And so on the stock side, that's avoiding those overvalued areas that sometimes are priced to perfection, which don't always work out as you would intend. It's looking for the industries, the sectors, the securities that have the goods and the services that they can provide, which will be leaders of those areas, whether we end up in a recession or not. And on the fixed income side, it's similar. It's not, again, avoiding risk by investing just in shorter term treasuries. It's managing the duration and the credit risk in light of where we are and the actions that the Fed may take. Yeah, but all this has to be done in the end with a big picture in mind. It's easy to get overly exuberant or overly cautious, and even week to week or month to month as you see what's going on in the markets. But by focusing on your goals, and by sticking to the course, you'll be in a good financial spot no matter what the market provides going forward.
Well, that's a good way to end our prepared portion. So thanks, Ethan and Kelly, for your insights today. So as we move into open Q&A, we just want to highlight that if you have any questions after the fact, feel free to reach out to speak with your financial consultant, or if you don't currently work with one, contact us and we'll be sure to have somebody reach out to you. But with that, we can move into the live Q&A. So we aim to select questions that are as broadly applicable to the audience as possible. Some of the questions that come in, we've touched on, and we want to make sure we get into some other questions that maybe we haven't really covered as much specifically. But please submit any and all, and if your question isn't answered, we'll definitely have somebody contact you very soon to address that question. So we will start off then with we had answered a few that came in along the way. One that I think is certainly on people's minds right now. I've had a few questions submitted ahead of time for this, but just sort of the overall economic outlook based on maybe some of the geopolitical challenges that we see out there. Certainly the war in Ukraine and Russia, the situation in Israel and Palestine right now, so in Gaza. So Kelly, could you touch on that a little bit?
Yeah, a lot of the time the market does have a way of shrugging off these geopolitical events, regardless of the massive human cost that comes with them. But when you're in a riskier environment like we are today, those events have a higher likelihood of starting some broader market downturn. The way we've talked about it a little bit is almost like a forest fire risk analogy. So you might drive through a national park and see, fire risk is low today, fire risk is high today. If there's a high risk of a fire, you don't necessarily know if there will be a spark or what the spark will do. But if there is a spark, there's a higher risk that it spreads broadly. And given everything I've talked about so far, we see this as a risky environment where any spark could spread to the broader market and cause a shift in investor expectations for the worse.
Yeah. And a question that came in, somewhat, I guess, well, certainly related to any of the economic challenges, but just sort of the thoughts on the length of an anticipated recession. So it was just, maybe the duration and what we might be seeing. Any thoughts there, Kelly?
Sure. I think both the length and also important is the severity. Typically, we would expect a more drawn out and severe recession if we're seeing really big excesses on the economic side. So if companies have massively overbuilt and they have a bunch of factories that are going to need to close, well, that's going to create above average economic pain. Certainly in the 2008 crisis, you had massive excesses and huge risk taking on the financial side. And that really gives you the biggest sort of 100-year flood type recession. And the setup we're seeing today is more of what sometimes academic literature refers to as a garden variety recession. It's a recession that we tended to get a lot more kind of prior to the 2000s onward. It's more of this, I would say, typical boom bust industrial cycle where inflation starts to run a little bit hot. The Fed steps in and ends the party, and you do have a recession, but it's not sort of that 100-year flood that we had in 2008. So yeah, I would say the setup today really is we're defensive now because we expect there to be pretty compelling opportunities on the other side that we'll want to take advantage of.
Yeah. And I think it's, it's obviously a challenge to, forecast out and to say, okay, this is what something's going to be next year, or how long something's going to last. And that's, another important part of what our research team does. And Kelly, is big part of her job is monitoring this regularly, looking at it. If there's changes, that's something that helps inform decisions that our research team is then applying to their particular areas of focus. So it evolves and it changes, and it's something where it's important when you have our team is looking at that regularly, and that's an important part of the job. We'll move to a question kind of planning related, I would say. So Ethan, this was one that makes sense for you to touch on, but a question just coming in about how to combat sort of a low performance, non-performing market. It's been discouraging for a couple of years. So just when you meet with your clients, I guess I'm sure that's not an uncommon feeling right now. So how are you speaking to that and talking about that issue?
Sure. And so I talk about it in a few ways. One is when you think about when an investor thinks about how much money they have, there's a sense to always take the highest amount of money they ever had in their accounts and mentally think that's what I have. If you ask an investor, how much they had over the last 10 years, they wouldn't think of what they had 10 years ago. They would think of what they had 2 years ago. And so, we're very cognizant that the last 2 years have been challenging. But the reality is, for most investors who start saving in their 20s or 30s and need the money last through their 80s or 90s, this has been a very difficult 2-year period during a 60-year time horizon that the money is needed for. And fortunately, the last 2 years came after a period of time where markets had provided pretty substantially positive results. I mean, the prior 10 years, from 2012 to 2021, 8 of those 10 years saw the U.S. stock market up double digits. And so I guess the saving grace of 2 tougher years is it came after a stronger period of time on the equity side. And on the fixed income side, as we've talked about, with yields being much higher now, the future outlook for total returns from fixed income is also stronger. So even though it's been a tougher 2 years, and we're not saying that it's all clear ahead, normally by kind of planning around this, you see these periods of time every decade or so, and it's part of the nature of investing.
Yeah, and that's something that I touched on with the 5-year slide. Was going back to the last webinar, we did focus on sort of those shorter periods that can seem really, really obviously sort of intense and bad at the time, but then when you stretch it out over a longer time period, maybe over somebody's investment time horizon, it appears more manageable. So it's a matter of context and staying focused.
Yeah, 2 years feels like a very long time when you're in it. When you look back, it becomes a blip on the radar.
So assuming you're invested properly, then you should just stay the course in a way, unless there's significant changes, and just try not to be too focused on some of that volatility, I guess, which is hard to do. But a question about we had a lot of questions and I guess concern about this, especially earlier in the year, but still relevant. It would be sort of relating to banks. So what is your take on I guess the solvency? This person asked about Bank of America, but I mean, probably can broaden it to just our sense of banks in general.
Yeah, I think the first big distinction that's important to make is sort of your big money center banks like Bank of America versus your smaller regional banks. The bigger banks have a little bit more safety. They have many more business lines, which helps them diversify and hold up a little bit better in times of stress. They're extremely regulated, more so than the regional banks, which gives them very, very strong, well-fortified balance sheets. And we actually saw deposits flow to the bigger banks when we had the banking stresses in the beginning of the year. Regional banks, on the other hand, they're not as diversified in their business lines. They had a harder time with deposit flight during the stresses. And they're also more exposed to the areas of the economy that we've already seen pain. So those consumer delinquencies I mentioned, and then also more exposed to commercial real estate, which has really struggled so far. So they're in a bit of a tougher position. The Fed has shown in the beginning of the year they are willing to provide some backstop, which helps a bit with solvency concerns at sort of the macro level. But given the pain that we do see in the banking sector, I think what we can have some confidence in and have already very much seen playing out is that lending conditions are probably going to remain tight. Banks want to remain conservative, not take on excess risk, and therefore not make as many loans. And that's going to just be another drag on broader economic growth.
Another one that just came in, related to what you just touched on, Ethan, but probably good to maybe, think through it a bit. But it's the question was, is the 4% objective for withdrawals, so maybe that 4% target, still relative, being that inflation is with us? So I guess, maybe just the question is that, so that 4 to 5% rule that people often use to think about what's a reasonable withdrawal rate to continue to manage your portfolio over time, is that still relevant? Is that still good, I think, based on the environment we're in?
Yeah, I'd say it generally is. Oftentimes when clients get to retirement or near, they think, okay, how much money do I need to be able to meet my expenses over time? And there's different ways some clients back into it. Some say, I have X million dollars, I want to spend 4% or 5% a year. Okay, can I live on that much money based on my lifestyle? Yes or no? The 4 or 5% kind of withdrawal, targets that have been, kind of discussed broadly were based on the fact that if inflation is historically around 3% and in an account that's half stock or half bond or in 7 or 8, you'd be able to withdraw for 4 or 5% while generally maintaining principal over your retirement years. And so, yeah, with inflation higher and results lower, this kind of gets back to what I mentioned earlier. It's how sustained is inflation, staying high, and how sustained are these market results that in this environment we're in today? That's really the key. And so what we do as a firm is, instead of saying, okay, can I take out 4% or not? It's, we look at what are your expected cash flows in retirement. Let's say you're going to retire in 5 years and you want to spend a certain amount of money, and you have, known Social Security or pension or other specific income sources, and you have these assets. Will that work? And so we use modeling software here to decide, is that plan achievable and sustainable or not? Because 4% for one person may be a very different situation based on the type of investment strategy they're pursuing than 4% for somebody else. So that's why planning is very personalized, and and that's why we focus on that as a firm.
Yeah, right. Again, it goes back to context, and some of those challenges maybe, again, over the short term, that withdrawal rate may appear challenging with inflation elevated, but yeah, when you really stretch it out over a longer time period, I think you don't want to necessarily say that it doesn't work anymore. It may periodically not work as well, but over time, right, it's going to likely
exactly. Yeah, and for the last 2 years, yeah, you could say it hasn't worked. The prior few years, you could say you earned excess that you could have withdrawn 8 or 10% or more, and so it kind of averages out. And I guess to directly answer the question is yes, it does still work.
I think we have time for at least one more question about investments that we really haven't addressed at all yet, which some people think about, and we actually get questions about this a fair amount, but relating to investing in gold or crypto. So maybe, Kelly, maybe we start with you on the gold side, and is there just our thoughts on investing in that right now?
Yeah, gold has definitely a much different risk profile from crypto, which is a little bit more of a traditional risk asset. Gold does tend to do well when things really go wrong. And it's also shown to be a decent store of value over the very, very long term. But sort of along that ride, it can be extremely extremely volatile. So it's hard to really view it as like the best safe haven asset because of that volatility. And as a hedge to equity prices, it's a little bit less appealing when yields on bonds are offering something appealing, which we do think is the case today.
Yeah, and as for crypto, there are a couple issues with it. One, there's less regulation in the crypto market than in some other markets, and then that's one of the many reasons there are pretty violent swings in the price of cryptocurrency. And a lot of the issue related to that is, the price of crypto is really, what is the market rate? What is someone else willing to pay for it versus what is its underlying, intrinsic value there? And so when we invest in ideas, stocks and bonds, we look at a company, we say, we think a company is worth X and it's trading for less than that. And so we find it as a suitable investment. And when it hits a price we think it's worth, we will sell that stock. That same philosophy and strategy does not work with crypto. Of course, you've gone through periods of time where it's done incredibly well, and it's also provided, challenging times as well. We don't think it necessarily has a place in our clients' portfolios today just because of what causes it to move.
Great. Well, I think that's the last question we have time for today. Thanks again, Ethan and Kelly. I want to thank everyone for taking the time out of their day to be with us. And we would greatly appreciate it if you can take a few seconds to fill out a survey that we have linked in the chat section so we can have some good feedback to use for future webinars. And if you're interested in learning more about Manning & Napier, please visit the link that you see on the screen there to schedule a call. Also, please visit our website to register for content that Manning & Napier creates, covering a broad range of planning and investment-related topics. Also, starting next month, we'll be conducting a series of what we call family finance workshops, and that's covering a range of planning topics. And these workshops are meant to be interactive events that focus on helping you and your family gain a better understanding of your finances at different stages of life and at different milestones. So whether your family is you or your family member is a recent college grad or just starting a family, maybe more established in your career and just kind of cruising along, saving as much as possible, or you're nearing retirement, we really wanted to build a workshop for everyone in sort of those different milestones. These are held virtually in group settings, so it's a great opportunity to both learn something new and ask questions that are maybe unique to individual situations. And you can sign up using that link, and there's links also in the chat section to make it easier to click right into. So with that, on behalf of my colleagues, Ethan and Kelly and Manning & Napier, thank you again and have a great day.